How do you do, everyone? Welcome to today's look ahead to next week. Excuse me, week 3 of 2023. This is the background. Since the beginning of 2022 until now, the S&P 500 has lost a great deal of its value, maybe at 20% of its value, 25% of its value. Interest rates, of course, have shot up from zero nearly to 4.25%, which they are now likely to continue. That's the environment we're living in. Inflation is here. It's not under control yet. And so we're looking at the big news next week is surely going to be the earnings report season, which gets underway, because this is the earning report that season that actually counts for something, because it's also the fiscal year, the fiscal year that closes also at the end of Q4. And so therefore it indicates the annual profit and loss for these firms. I'll just review quickly how the trade usually works. Take a company like Procter & Gamble, say, or any one of the ones that here's Procter & Gamble. We see, and I have the earnings reports demarcated here just to give a time sequence. This is a daily chart. The strategy is straightforward. If the price of the stock is up in a particular quarter and the expected earnings report is positive, this fiscal year, they're all positive. Less than last year, I noticed. And I'm going to point that out, why that's important in a moment. Notice this year, they're all positive, but less positive than last year in all cases. The idea is quite simply then to purchase the stock before the release of the report with the expectation that if the report comes out as expected, remember, the key is that they go along in the same direction. The report is expected to be positive and the price has risen for the stock. Then when the report comes out, if indeed positive, oftentimes, remarkably well over 50% of the time, the stock pops up in that direction. How long it stays above the pre-release data it depends on a lot of factors. But as a short-term trade, it's reliable enough. And all of them that in the next week anyway, Procter and Gamble, are all looking positive. They all have the same setup. Nobody's down. Netflix is up. I didn't check Intuitive Surgical, but Alcoa is up. Morgan Stanley, Goldman Sachs. They've all done reasonably well, but they're going to do less well. And I want to come back to this in a moment. This less well business. The banks that reported out today are making money hand over fist because of the rise in interest rates. And a lot of these companies are still making, in their reports, handsome profits. I just want to remind you of this, and you can interpret it how you want, but I think it's crucial to understand these. All financial reports are backward looking. They're historical. They're snapshots in time and in our fast moving world, like sometimes ancient history. So fiscal year 2022, while having to deal with rising borrowing costs, are going to be faced with further hikes in borrowing costs in 2023 with depressed demand. The top line is falling, and that was evident again just simply from the S&P 500 chart, just a gross measure of U.S. economic activity. It's down. I mean, there's no denying that. It's below the two. It's just kissing the 200-day. That seems somewhat positive, but again, it's just this rise is on declining volume. So it's hard to say how serious that really is. I say it's not likely to continue. But the point of the matter is, this earnings report season, while the setup is the same all the time, this business about the projected decline in top line revenue and therefore the bottom line profit is what many people are going to be paying attention to. So that increases the risk, because the risk is that the trade will not play out as expected. In other words, the report will be positive, everything will look good, and then the stock will fall for some reason because within the earnings report disclosure, it was disclosed that the company feels that the next quarter or two are going to be significantly more downbeat, and therefore it's not going to go in the upward direction if that was the indicated direction. That's the risk. So I make you aware of that for week number 3. That's really what's happening. Mostly the earnings reports. Inflation is not likely to get arrested anytime soon, And while the numbers continue to look somewhat better, we're far from having that genie back in the bottle. So interest rates likely to rise. And you'll notice also, just one last thing I'll point out to you. Those of you who take a look at the bonds, this once interest rate seems to have, not seems to have, but actually has indeed started to reflect reality and reflect borrowing costs, the bond prices have gone up. That looks like a good trade, likely to have legs and to continue well into the future. So keep that in mind. High interest rates are now affecting the bond market such that these bonds are being bought up again and their prices are rising because, well, I won't get into the technicalities of the bonds. It doesn't matter. Interest rates rising, bond prices rising nicely. So that's a good thing as inflation seems, is under attack. These bonds become more valuable. So, ladies and gentlemen, that's going to do it for this week. It's going to be a hectic week in the markets. The beginning of January is always one of the most active times in the markets because of the importance of the Q4 reports, and and now, of course, everything is heightened because we're battling inflation. There's going to be a lot of winners and a lot of losers. So that'll do it for today, ladies and gentlemen. I'm your host, Seth Julian, wishing you all the ability to trade with confidence. Bye-bye for now.